Hello, 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 and welcome again to Freedom Ain't Free. Today's video, we're going to be talking about how much does financial advice cost. We're going to dig into the cost of investing. We're going to talk about the different types of investor fees because I want you to have a thorough understanding of how to engage and interact with financial advisors or agents in this space. So, if you're new to the channel, welcome to the Freedom Ain't Free. The purpose of this channel is we want to share with you all the wisdom, knowledge, and understanding of how all of the financial tools that are available to you work so that you can add them to your overall portfolio to get you to a state that we like to call financial freedom. My name is Joel Huey. I'm the principal at ARC Financial Strategies, where predicting the rain doesn't count, building the ARC does. At ARC, we work with a group of people that we like to refer to as Henrys. They are high earners, not rich yet. Our goal at ARC is to help our clients get to that state of financial freedom, which we define and from a perspective of income. We want our clients to have between $120,000 and $160,000 a year coming from their assets, which means we need to help them to develop a $1.5 million to $2 million portfolio in order to accomplish that so that you can pursue the things in life that are important to you. Get out of the work rat race, get out of the business rat race, be able to focus in on your family, focusing on the things that you are passionate about, and now your personal finances are creating that income that you need to be financially free. So, today's video, we're going to be talking about the various different costs or types of costs that are associated with getting advice. But before we dig into that, I really want to just kind of help you define what advice is. So in our industry, financial advice takes a lot of different forms, right? The three main ways of compensating an advisor or an agent, I'm going to define the differences between the two here in a second, but the three main ways of compensation falls into commissions. Then there are flat fees, and then there's what's referred to as management fees. Those are the three main ways of compensating your advisor and or agent. The way that they are decided basically first and foremost begins with who you're working with, right? So you have to have different types of licenses to be able to charge different types of fees. So as an example, commissions are generally formulated or generally require you to have an insurance license or annuity license, or you may have a basic registration license from FINRA, which would allow you to earn a commission on the sale of a product. When you move up to the flat fee space, those are true financial advisors. They have to have a Series 65 license, or some may have a Series 66 license in that space. That is a particular license that is earned by passing a series of exams that are administered by FINRA. If you want to move into a management fee, that requires a different type of license. Generally speaking, the 65 will cover that for you, but you may also need a Series 7 in order to be able to move into a position to be able to charge a management fee, right? So when you look at the commission-based space, those are usually agents. They may refer to themselves as financial services professionals. Some refer to themselves as financial advisors incorrectly in that space, but it kind of depends on who they work for, what title they're allowed to use. But technically, you have to have a Series 66 or a Series 65 to call yourself a financial advisor. You had to pass those specific exams in order to be in that space. So if you're working with an advisor who is not charging you a fee for his or her time, or is not charging you a management fee, they're earning their income from a commission-based compensation plan. Now, there are pros and cons to those particular types of plans, but the conversation today is basically from your perspective, right? So from the customer's perspective, from the client's perspective, if you're working with an agent who's earning a commission, right? So the insurance company or the broker dealer is paying that person a commission for bringing business to them. That commission does not come from you, does not come out of your funds. It comes from the insurance company, or it comes from the broker dealer. Now, what do I mean by it doesn't come from you, right? So if the agent is earning a commission, the insurance company or the broker dealer is absorbing that within their cost, right? So why would they do that, right? So to understand how the industry works, most people within the industry are not regular salaried employees, right? They don't earn any income unless they help you accomplish something that you want to accomplish. So the insurance company or the broker dealer is not paying them for their time. They only pay them when they actually provide or bring a client to the insurance company, right? Why is that important to understand, right? So you may be in a scenario where you get a paycheck every 2 weeks, right, or every week, right? So you go in and you trade that hour for that salary or that hour for that dollar. Well, most commission-based employees don't earn their income that way. If they don't sell anything, they don't earn anything. Therefore, in order to attract the type of agent that the insurance company or the broker dealer needs, they need to be able to compensate these people in a greater capacity for the sale because they're not paying them for their time. Why is that good or bad for you? Well, good for you because you get to sit and have a conversation with that agent, ask them all the questions you want, get all the information you want, get all the research done that you want, and you're not going to actually pay them for any of the time that they spend providing you with all of that data and research, right? So that's good for you. Bad for you, the recommendation that they make towards you or the information that they bring towards you could be biased from their perspective because that they earn a higher commission on this product versus that product, right? The due diligence being on you, right? If the solution that they're providing to you is going to get you where you want to go, then you really shouldn't care how much money they made to bring you that solution, right? So these are all my opinions, but that is my opinion on the matter, right? If I'm at point A and this solution is going to get me to point B and that's where I want to go, and I'm not having to compensate you for the research, the time, the effort, and the energy that you're spending to bring me all of that information, then whatever the insurance company or the broker dealer is paying you is between you, the insurance company, and the broker dealer. I got what I needed, right? And if you're in a position and you're just getting yourself moving in the direction of developing or creating a portfolio, getting free information, getting free research, there is still a price and a cost for that. You're just not paying it. That is if you're working with a commission-based advisor. If you move over to a flat fee advisor is going to tell you up front in the beginning how much they charge for their time, right? If you want to have a conversation with me, you want me to do research, you want me to put plans together for you, you want me to make recommendations to you, I charge X amount of dollars for that service, right? You're going to generally pay that up front, or they may give you an option to pay that over an installment period of time, but you are literally writing a check, paying them out of your pocket for their advice. Now, in that particular space, they're not reliant solely upon commissions in order to earn their income. Therefore, the advice that they bring to you is going to be much broader in nature because you already paid them for their advice. Now, they may in turn earn a commission from the insurance company or the broker dealer on the backside. It just depends on the relationships that they have set up, and they have to disclose that to you, that in addition to the fee that they're receiving from you, that they're also earning a commission from the companies that are back there and supporting. Again, remember, they're not getting a salary. They're not earning any income off of their time or just showing up. They only make money is when they bring on new clients. And so their expertise, their focus, those individual pieces of the puzzle are all there to benefit you and help you accomplish what you want to accomplish. That is a fee-based advisor. When you move into a management fee-based relationship, and for most people, you experience this within your 401ks or your IRAs types of accounts. Those types of accounts, you're paying a management fee. You're paying an advisor to actually manage your investments. They're making recommendations to you about which stocks, bonds, or mutual funds to buy. They're making recommendations to you on when to hold and when to sell. All of those pieces of the puzzle are wrapped up in that management fee. That management fee also includes, generally speaking, the fee to the fund family that's actually making the trades. You're generally included in that. Now, depending on your relationship and generally speaking, just cutting the mustard, how much money you have invested with them will determine how frequently they reach out to you. It will determine the recommendations that they make you, the speed with which they get back to you. All of that is going to really be based upon how much money that they are managing for you. I suspect with most of my clients, they've never actually ever heard from their advisor who's managing their 401k. They may have gotten an email once or twice here or there. But you, generally speaking, if you want to have a conversation with them or a meeting with them, you would have to engage with them. They're not going to necessarily reach out and engage with you because they're earning that management fee every single solitary year off of your investment. Your employer is more their client than you are individually, although you do have access to them. If you have a brokerage account or individual account outside of your employment situation, then you have a direct advisor that you are working with or that you could get in touch with if you're working with one of the major custodians or something along those lines. So that person is earning a percentage of your investment account balance, right? So as your account balance grows based upon the advice that they give you, they earn more money. You make money, they make money, right? Now, each one of these types of compensation structures has their pros and their cons. That's not what this video is about. This video is about simply explaining to you how the three different individual pieces of the puzzle pull together. And here's why I'm not digging into the pros and cons. With the group of people that I work with, so I'm working with Henrys, right? High earners are not rich yet, right? Depending on where you are on that pendulum is going to dictate how you need to engage with advice. But what I want you to understand is that going at it alone is a very expensive pattern to work with, right? Or a very expensive way to go about doing it. There's no such thing as free. Freedom ain't free, right? So if you want to go about learning and reading and studying, so I have an insurance license, an annuity license, and a long-term care license. I also have a FINRA Series SIE, a Series 6, a Series 63, a Series 65, a Series 7, and a Series 24 General Principles license. I'm just about done with my Charter Financial Consultant designation through the American College. I've spent close to 10,000 hours studying personal finance. It's going to take you a long time to get all the wisdom, knowledge, and understanding that I have, or you can simply pay a fee for access, right? Depending on who you're working with, it will determine how much access you have with that individual person. But if you're just getting to the point in life where you've got now some extra money that you're ready to save and invest, and you're tired, you're looking at another 25 or 30 years of working, or 10 or 15 years of working, and these next few years really, really matter, you're going to want to engage with an advisor who can point you in the right direction, help you not jump over or miss opportunities that are available in the marketplace, and most importantly, explain to you how each one of these particular pieces of the puzzle come together and which one is the best option for you. And then make your choice. Whether you want to work with an agent, you don't want to pay anybody, you don't want to write any checks, you don't want to give up any percentages of your growth and gains, you go with a commission-based advisor, right? If you want to talk to somebody, you want to be able to call and talk about anything or ask a question. You're buying a car, you want to ask a question. You're buying a house, you want them to review your paperwork, right? You want a fee-based advisor who works directly for you. You're going to write that check. Assets under management, you want somebody just to manage your money, focusing on growing your stocks, your bonds, your mutual fund portfolio, or, wherever you are in the spectrum, there's somebody out there, there's a practice out there that fits your style and what you need. What I want to encourage you to do is find you somebody to work with that's going to give you the wisdom, the knowledge, and the understanding of how all of these tools work, because you need to put them all together to get you to financial freedom. When you're working in a taxable state, whether you're dealing with CDs or savings accounts or your fixed accounts, or whether you're working with an individual brokerage account and you're buying mutual funds or you're buying stocks and bonds and you're selling them this year, you need somebody to work with you there. Whether you're in your qualified space, your tax deferred space, you got a 401k, a 403b, you got a VRS, you got a TSP, right? And you're buying mutual funds inside of that long-standing retirement account. You need somebody who can show you how to maximize that and get the most out of that. Whether you got a traditional IRA, you got a tax-deferred annuity, you got a deferred compensation plan, each one of those pieces of the puzzle is going to require a specific type of advice in order to help you understand what's the difference between this versus that. And then lastly, if you're in the tax-free space, you're working with Roth accounts, you're working with municipal bonds, you're working with 529 plans, you're looking at cash value building up in the 4 different types of insurance strategies that are available in the marketplace, you're going to need an advisor to help you navigate those different components and make sure that you're getting the best one for you to get you to financial freedom. And at ARC Financial Strategies, we like to tell our clients, you need $1.5 to $2 million to be able to retire in America with some dignity. How much money do you need to save on a monthly basis to get you there? We like to refer to that as your freedom number. There's going to be some links in the description where you can jump in and get a free consultation with us. I'll jump in and I'll tell you exactly how much money you need to save on a monthly basis, what type of return you need to get for you to get to that $2 million portfolio and be financially free. What we want you to understand is freedom ain't free. It requires knowledge. And how do you get that knowledge? You could go out and self-study it for yourself, or you can hire an advisor to help you navigate the turbulent waters of personal finances here in the United States of America. Once again, my name is Joel Huey, principal at ARC Financial Strategies, where predicting the rain doesn't count, building the ark does. Thank you for joining us once again on this episode of Freedom Ain't Free. We look forward to seeing you next time. Have a great day.